welcome everybody. David Griffith with the LGBT Elder Initiative. And so I just want to take a quick moment to extend our thanks to Community Legal Services for being here tonight and delivering this presentation on reverse mortgages and foreclosure prevention. And so Michael, in addition to knowing a lot about Philadelphia neighborhoods, is also the managing attorney for their homeownership and consumer rights unit. He's going to tell you a little bit more also about what Community Legal Services does. And again, a lot of their materials and resources are at the back table, so check those out before you leave. And with that, I won't take up any more of their time, and I will turn it over to Michael.
Do folks know what Community Legal Services or CLS is? Have you ever heard of it before? Yeah. So essentially, CLS, or Community Legal Services, has been around for, I think 52 years. And we provide free lawyers for people who are low income or middle income in Philadelphia who are having all sorts of legal issues regarding their homes or their jobs, or you're trying to apply for disability benefits, have problems with PICO or PGW. We help I almost said landlords. We help tenants who are having problems with their landlords. We help people who are having problems with the housing authority. Essentially, if you've got a legal issue and it doesn't involve the cops and you're not being arrested, we probably can help you out with it. And so what Gigi and I do is we work in the Homeownership and Consumer Rights Unit, which basically means we try to save people's homes. When they fall behind in their mortgage or they fall behind in their taxes and the bank tries to take the home away or the city tries to take the home away, we do our best to save your home. We also get involved in consumer issues and the consumer scams where people try to, pull one over on you. And we will represent folks to try to go after the scammers. This purple page, which is on the back table, provides a list of all the types of things that we do. We've got office is in Center City, right by City Hall, and I work out of the office in North Philly at Broad and Erie. And I think that is it for introductions. All of our services are free, and when you come and talk with us, everything is confidential. All right, so I was asked to come today to talk about one of my favorite issues, which is how to keep your home. So in Philadelphia, I think unlike a lot of other major cities, we are a city of home ownership. And a lot of people own their homes, especially, and a lot of low income and middle income people own their homes. And when you go, for example, to New York City, you don't have that. Even when you go to places like Boston and other cities, you don't have that. Philadelphia is a town where there's a lot of pride in home ownership. And not only is there pride in home ownership, but there's sort of a pride in sort of passing your home down to who you want to pass it down to either your family or your chosen family, but you've worked hard, you've sort of have purchased a home, and now you get to decide who to leave it to. So what we're going to talk about today is essentially, once you have a home, how to do whatever you can to make sure that you keep it. And so I'm going to talk about a few things today that were sort of that I was asked to talk about, such as reverse mortgages and tax foreclosures, because we've seen a big issue in Philadelphia lately with tax foreclosures. But I'm also here if you have any questions that you want to talk about about home ownership generally, or deeds or estates, things like that, let me know. And certainly if I know the answer, I'll tell you. If I don't know it, I won't make it up. I'll just tell you that I don't know it. There are some lawyers who just make up the answer, but not me. And I can tell you, if I don't know it, I can also tell you how we can together find the answer out. If as I'm going along you have any questions, you could just raise your hand and we'll deal with it as they come. And for the purposes of today's being recorded, maybe what I'll do is I'll just repeat your question so that's picked up on the mics. All right?
Okay.
All right, let's jump in. Is it I know I just met you all, but is it too personal to ask whether folks in the room own their own home?
I don't own my home.
Okay, you don't. I was talking with you and Gail before.
Not yet.
Not yet.
Soon.
All right. How about, if you feel comfortable, could you raise your hand if you do own a home? Okay. Gotcha. All right, so I just want to make sure that basically we're talking about the right thing. Or not the right thing, but sort of the applicable thing. And for those that don't own your own home, I'll try to entertain you anyway. Although, it's interesting. I'm a lawyer and I represent people with home ownership issues, and so I have some specialty in foreclosures as well as the 8 or 10 people that are in my unit. And I think half of them have decided not to own homes because of all the trouble that people run into and prefer to be renters. So the first thing we're going to talk about are reverse mortgages. All right. What is a reverse mortgage? Does anyone know? Yeah, sir.
Sort of, it's you can take the money out of the worth of the house.
Yeah.
This is done with the government, I guess, essentially.
Yeah, the government insures it. It's a private bank that will do it, but the government insures the transaction if something goes wrong. So it's essentially, the way I like to think about a reverse mortgage is that you're essentially selling your house to the bank, and the bank is allowing you to stay in the house until you die or until you move. A lot of people think about reverse mortgages because as they age and they are running out of money, then it's a way to get money and use the equity in their home, the value of their home, as sort of like retirement planning. So you have to be 62 years of age or older. If you're married, then you and your spouse have to both be 62 years of age or older if both of your names are on the deed to the house. There's special rules about if only one spouse's name is on the deed. You can either take it out as a lump sum payment, or you can take it out kind of like as an annuity, where you get money every month for the rest of your life. Let's say your house is worth I don't know, typical Philadelphia house, $100,000, $120,000. Just to make the math easy, let's say it's $100,000. So your house is worth $100,000, and you're the only person on the deed, and you're 62 years old. You may only be able to get a reverse mortgage for $30,000. But if you're 72 years old, now you might be able to get $60,000. And if you're 82, then you might be able to get it for $75,000, because they have these charts, these actuary charts, to determine how much longer you're going to live. And so the younger you are, they think you're going to live, decades longer, and so they're not willing to give you as much money because the money will continue to grow while you're there, and they want to make sure that the money that they loan out to you plus interest doesn't exceed the value of the home at the time of your death.
Get into the interest part now.
Yeah. What did you say?
Get into the interest part
Yes.
now, because when I speak to the people, you don't get a straight answer.
Right.
The other thing is when you see the commercials and you call up, you get no information about what's happening. And this is
Right.
I just started talking about the
Yep.
interest.
So the typical interest rate is about these days I think it's around 4% or so. Although don't quote me on that. So if you borrow $100,000 at the end of the year, you'll owe $103,000 plus insurance that you're paying to HUD, basically.
So
Insurance for what?
To HUD. So you had mentioned they're government mortgages. They're not really government mortgages. They're the reverse mortgage company will loan you the money, but you have to pay HUD for insurance on it, which is taken in two ways. It's taken at the origination when you get the reverse mortgage. They'll take it from there, and then every month they'll add on the insurance premium to your outstanding balance.
So when you say at the end of the year it's $103,000, that's the interest
Right.
added on to the value of the house?
No. Interest that's added on to the amount that you owe on your reverse mortgage.
From what you have taken out?
Exactly.
So let's say your home is worth $100,000.
Yep.
They give you $50,000. So there's $3,000 interest. Does the other $50,000, does the $3,000 interest come out of the equity that's still left in the house after they give you the $50,000?
Great question. So here's the way I like to think about it. The balance will keep growing every year, every month actually. The balance
Balance of what?
that you owe for the reverse mortgage will keep growing. It'll be, let's say you do 50,000. After 1 year, it'll be 53,000. After 2 years, it'll be 55,000. After 3 years, it'll be 59,000. It'll keep growing both on the insurance and because of the interest from that loan. Let's say, unfortunately, you pass a year after you take out the reverse mortgage. Then, essentially they'll sell the house at a sheriff's sale, assuming you don't do anything to stop that, or your heirs don't do anything to stop that, and the equity, in other words, the 100,000 minus the 53,000, will go to your estate. Got it?
So when they tell you, you could always buy back the house whenever you want, you can't, because they don't tell you about the insurance and the interest payments. You never hear about that. So you really never get the house back, even though they say you do, or you could sell the house and get the remaining equity.
If you don't remember anything else that I say tonight, remember this. Once you take out a reverse mortgage, you're not going to be getting that house back. You're not going to, unless you hit the lottery and you want to pay off the reverse mortgage at that point. You're not going to get it back. Yes.
What if you have liens on your house and you have outstanding maybe water bill or gas bill? Because my mom died,
Yeah.
so I inherited the house, but I'm the owner now. But she had prior, gas bill that was real, was
Yeah.
outstanding. Water bill and we've
Yep. Okay, so the question, just for the recording, is what happens if you have liens on your house, like a gas lien or heck, a mortgage? What if you still are paying a mortgage off? The answer is that when you take out the reverse mortgage, before you get any money in your pocket, your liens are paid off. So let's say you get the $50,000 for a reverse mortgage, and you have a $2,000 water lien and a $1,000 gas lien and a $2,000 or $3,000 credit card judgment that was on that was liened on your property. Those all get paid off. Plus, there's other charges that come at origination. When I say origination, that's like legal word for like when you actually take out the mortgage. And so those all come out first. Yeah.
If you have a line of credit that you're taking out on the house, and let's say you owed someone that, would that also be taken care of?
That's correct. Yes. So the question is, would you have a line of credit? Does that get paid off? Not only does a line of credit get paid off, but so do regular mortgages, regular forward mortgages. So I'll give you an example about some people who take out reverse mortgages, and maybe it makes sense. And here's what it is: you take out you buy your first house when you're 50 years old. It's a 30-year mortgage. So that means that when you're 80, you'll finally pay it off. Now you're 65 and you retire, and you realize that you don't have enough Social Security and a pension or retirement savings to continue to make your monthly mortgage payment every month. So you take out a reverse mortgage at that point and pay off the forward mortgage, because from that point on, you would no longer need to pay your monthly mortgage payments. Follow? But that is where we start getting into the tricky parts here. So we kind of just jumped right into this. Take a look at that third bullet point. Oh, I have copies of this for everybody. I forgot to distribute these. Sorry. Hey, Gail. Can I... here they are. Please hand these to you. Thank you. Or Gigi or whoever. Oh, I gave them all. Yeah, sorry. Sorry, I just remembered that. So that third bullet point. Reverse mortgages are sort of like sold to people with the idea of you won't have to make any monthly payments after you get out a reverse mortgage. And what's sort of glossed over at the time is that you do continue to pay your property tax and homeowners insurance. In Philadelphia, every year about 400 or 500 foreclosures are filed against people who have reverse mortgages. So you get a reverse mortgage and a foreclosure is filed to still take your house away. And the most common reason for those reverse mortgage foreclosures is because people fall behind on their taxes and insurance. The reverse mortgage company swoops in and pays them for you. And then the reverse mortgage company turns to you and says, you have to repay me. You have to repay the reverse mortgage company for the taxes and insurance. And sometimes they offer a payment plan to pay it off. Sometimes, depending on your circumstances, they won't. And if you can't pay them back, then they'll file a foreclosure to take the house. At Community Legal Services, this is one of the big issues that we struggle with, is seniors who come in to see us who took out reverse mortgages, who didn't realize that they would continue to be required to pay the taxes and insurance. This happened to them, and now they can't come up with the money to pay the taxes and insurance. So if you take out a reverse mortgage, just remember that you continue to be responsible for those costs. And before I get to the questions, just one sort of to highlight. Remember a moment ago I said some people take out reverse mortgages to pay off a forward mortgage. With a forward mortgage, many people sort of aren't in the habit of thinking of that I'm paying taxes and insurance because it's in my escrow payment, right? And so they get a reverse mortgage, pays it off. You have to then sort of adopt this new way of thinking that you are required to continue to pay the taxes and insurance. You had a question?
Yeah, because I'm sure some seniors think when they get a certain age that they don't have to pay property taxes anymore. Didn't they do a moratorium on the taxes, or they at least don't go up, or something for seniors? I know.
Yeah. It's called the senior tax freeze. I'm going to talk about that in a little bit. The answer is that for very low income seniors, you can freeze the amount of taxes that you pay so that they won't go up in the future. For other seniors, and actually for other Philadelphians, there's a program that will essentially, and this is really boiling it down to its basics, is essentially add your taxes on. It'll be a lien on your property, so you won't have to pay your taxes in the future. I'm going to get to that. And don't just do that. You need to actually be enrolled in this particular program to do that.
What's the name of that program?
Owner-occupied payment agreements, and it's the one where you are not required to pay anything is Tier 5. But I'm going to talk more about that in a second, so I'm going to come back to it. There was a question right over here, and then I'll... Yeah.
I was going to ask, let's say you get a reverse mortgage. Does one of your family members get the first right to purchase the property from the reverse mortgage company before it goes on the open market or sheriff sale?
Sure, they sure do. Do I have that here? No, I think I have it on a future slide. Leading into that question, let me just say the last bullet point here is so when you get a reverse mortgage, you're required to go through this counseling, and it's an hour long. And I've looked at the paperwork, and everybody that gets a reverse mortgage, they sign something saying that they went through this hour-long counseling. And yet, at least once or twice a month, people come to me and they say, I want to leave my house to my friends, my nephews, my nieces, whomever. And I say, well, you have a reverse mortgage on your house. And then I'm the one that has to say, with a reverse mortgage, you won't have a house to leave to anybody. It goes back to the bank. And I'm the one that's telling them that. So even though somebody goes through this counseling, either the counseling is really bad and doesn't exactly explain this, or the person who is originating the reverse mortgage has an incentive just to sort of gloss that off or not exactly explain that. So the question that was sort of my prologue into his question, which is, do your family members, I think you said, have the right to sort of buy the house? And the answer is yes. And not only do they get to buy the house, but there's an advantage for them to buy the house. So I'm going to try and keep the math real simple here. Let's say that your house is $100,000 and it doesn't appreciate, it just stays $100,000 just for the purposes of this exercise. And when you die, your reverse mortgage balance is $70,000. Your heirs can buy the house for $70,000. Now let's say that you live to 110 And the reverse mortgage balance kept growing and growing and growing, and the reverse mortgage balance is now $180,000. There's a special rule that says that your heirs can actually buy it for 95% of the assessed value. So your heirs won't have to pay off the whole fair market value. They won't have to pay off, in this example, $180,000. They can buy it for $95,000. So your heirs can buy after a reverse mortgage, after you die, your heirs can buy it for the lower of the amount that is owed on the reverse mortgage or 95% of the assessed value. There's timelines to do that. You've got to notify the reverse mortgage company within 6 months of the death that you want to do it. They can be extended, but you need to get right on top of it. So this part is emphasized at the origination of the reverse mortgage, that your heirs can buy the house when you die. What isn't emphasized, though, and what you'll need to just sort of think through is, do you think your heirs are creditworthy enough to get mortgages for that 95%? Because many people that we see at Community Legal Services are not able to qualify for mortgages to afford to come up with that amount of money. Yes.
When the lady was talking about the taxes,
Yeah.
you have to pay, can you just pay principal, or you have to pay the penalties that's incurred?
This is on the owner-occupied payment agreement. I'll tell you what. I think taxes is the next topic here. So should I just go on to taxes? Does anyone have any more reverse mortgage questions?
Yeah.
All right. So we'll get to taxes in a second.
Couple of questions.
Yeah.
You said you have to pay the HUD insurance.
Right.
So, how much does that normally cost? Is it a percentage or?
Yeah, I don't know. I'm sure that they have tables, and so I don't know offhand. This is what I know as we're standing right now. I recently represented somebody who got $60,000 out. Their HUD insurance at origination was $2,100, and every month they added to the principal about $100 on it. So I don't know the actual details of how much it is. But there it is. At origination, there's other charges as well. Like, there are charges to take out the reverse mortgage. You'll be paying several $1,000s to the bank to take out the reverse mortgage.
Plus, you got to pay for when they come to inspect it, and I know you got to pay for the counseling also.
Yep, and title report and all that. Yep.
Or when
Yep.
you have to live in the house?
Yes, you do need to live in the house. Yep, it needs to be, as they say, your primary residence. Oops. Plug in another power source. Do we have that? Oh, God, it's come. Yes, sir.
What is the advantage of taking out the whole value that you can get from the house versus monthly payment? You could invest some of that money?
Yeah. I'm not sure, and this is why. Because the people that come to see us at Community Legal Services, because they're all lower income, I have never seen somebody who has taken out less than the full amount. I'm sure there are people who could talk you through that, but it's not me.
Okay.
Yeah. Yes.
Under what circumstances would HUD collect? In other words, what are they insuring against?
Yeah.
Foreclosure?
Well, it's a good question. I think most of the benefits go to the lender. Yeah. So the biggest the HUD insurance program for reverse mortgage is not very healthy right now. They're paying out a lot of claims, and that's partly because people are living longer than the reverse mortgage folks thought. But the big claim that they get paid is this. So that previous example, your house is worth $100,000, you get $50,000, you live to your $180,000, you sell it at a sheriff's sale for $100,000. It's not like the banks never lose. So the banks.
It sounds like
right.
You're going to the casino and
Right.
buying insurance in case
right.
you win.
So you see that $100,000 to $80,000,
Losing.
right?
Well, guess what? That's
Right.
how it works.
Yeah. So HUD will pay them the difference of the amount that the balance of the reverse mortgage and the amount that they get from the sheriff's sale.
Let's say the house is worth $100,000.
Yeah.
They give you $50,000 in a lump sum. Then with interest and everything there, you know, you already 75,000 into the loan, let's say you died, what happens to the other 25,000?
So it depends. So let's say your heir, it goes into your estate now, right? So your heirs
Okay,
probate your
the bank
estate.
does not get it.
The banks do not get it. That's correct. Yeah, yeah. That's the short version. These are things I mentioned. So why do people take out reverse mortgages? Well, this is a big part of it, I'm afraid. That they're relentlessly advertised.
You say it's better to take out reverse mortgage when you're aging than when
Yeah. For most people, yes. But listen, like what if you saved money, you become disabled at age 55, you can't work anymore, you spend your retirement savings, now you're 62 years old, and you don't have any money, and you have a house that's worth $300,000, but your only income is SSI of $750 a month. If somebody comes to me in those situations and says, should I take out a reverse mortgage? And I'll be like, well, it sounds like a good possibility. And they'll say, but wait a second, you just spent an hour telling me how dangerous they were. And I'm like, well, both can be true. It could be true that a reverse mortgage is a good option for people. I just want to make sure that if you decide to do it, that you know exactly what happens and what you're looking at. Yeah. In the law, we call events where you may lose your house, we call due and payable events. I think as we talked here, we hit them all. The one we didn't talk about is maybe the third bullet point down. The borrower changes their principal residence. I'm currently was working with somebody who had a stroke. She went to the hospital. She went to rehab. She went home to recover with her son in she went to her son's house in South Carolina to recover. She was gone from the house for about a year and a half, 2 years. She got better. She had a reverse mortgage. While she was out of the house, they started a foreclosure against her because they realized she wasn't living there anymore. But they only sent the paperwork to the house, so she never got it. So she came to us and she said, I never got the foreclosure paper. Can you help me with this? And I said, well, we could, but even if we could sort of fix, say you never got the paperwork, the reality is that because you were out of the house for 12 months, even for a good reason, you're recovering with your son, that is a due and payable event that the reverse mortgage can collect on the house.
Okay, so if you suppose you own more than one property,
Yes.
can you do it on each property or not?
Only your primary residence, only the one you're living in. All right, what else we got? Oh, yeah, sure.
That saleable conditions clause.
Yeah. What is it?
Yeah. Sound like it's kind of arbitrary. You live too long. Oh,
Right.
You can't sell your house.
Right.
We
Right.
need the money now. That's what it sounds like.
Let me
skeptic.
answer. So the question, just for the recording, is what does it mean to maintain the property in saleable condition? So the first thing I'm going to tell you is that I just finished looking at data for all of the reverse mortgage foreclosures in 2016 that Gigi put together, actually. And I think there was like one foreclosure that was for this reason, okay? So it's not a huge thing. I'm a lawyer, I want to be complete, I put it on the slide. This is the way we usually see this. Whenever you get a reverse mortgage, the bank is going to send somebody out to look at your house to make sure that you're living there, that it's in good condition, to find out how much money it's worth, etc. And it's not uncommon for the company to say, you need to fix the house up by putting. I just saw you need to put a railing on your front stairs, and before we give you the loan. And so the person put the railing on, got the loan. But in the event that the tree falls down or something and you don't fix it up, then they could theoretically say, you need to fix the damage from the tree within a certain amount of time or we're going to foreclose. It's not a frequent occurrence. Of all the problems of all the things you should be thinking about a reverse mortgage, this probably isn't one of them.
It's just, all the houses need work, especially if you've been in it 30 years.
Yeah. Yeah. No.
Like you say,
It's not a big thing. Yeah, I was just thinking. I bought my house 10 years ago, and I remember doing a bunch of repairs in the beginning when we got our house, and I was like, this will last like 10 years, this repair. And now 10 years later, it's still in the house and everything's breaking again that I fixed. Yeah, so even if you've lived it only 10 years. All right, I wanted to highlight this. This is a map. It doesn't, maybe it'll turn out better on their handouts. But yeah, it looks a little small here too. This is a map of where foreclosures were in Philadelphia a few years ago. And what I'm always struck by is that the foreclosures are happening in like particular neighborhoods. And most of them, and you can't really see it, but the smaller green dots refer to when the foreclosure is happening for like less than $10,000, and the bigger green dots are the ones that are happening for $100,000 or more. And what I'm struck with when you look at this, the larger map, you'll see it a little more, is that people in poor neighborhoods are losing their homes to reverse mortgage foreclosures for less than $10,000, which to me means taxes and insurance defaults. I don't know. I think at this point, I need to make one, before we go on, next one's tax foreclosure. Before I talk about tax foreclosure, though, I need to say one last thing about reverse mortgages, and that's this. For some people, and I want to be as clear as I can about this, for some people, reverse mortgages are the solution, right? They are, as I mentioned before, house rich, but cash poor. And this is their strategy. This is their retirement strategy. It's especially good for people who may not have children that they want to pass it on to, or other heirs that they don't want to pass it on to. And they think, well, I've had a good life. It's a nice house. I want to continue. I want to, be able to travel a little bit when I retire. Reverse mortgages are probably a good solution or a plausible solution for those folks. The reason why I sound so negative about it is because people come into CLS all the time, and they didn't go into the whole transaction with their eyes wide open. And so part of this presentation, I think, is just to make sure that you know that there are a lot of issues with these. I mean, the other thing too is that people don't come to lawyers to say, "Hey, my reverse mortgage really worked out great." They come right because it didn't. All right, let's talk about tax foreclosures. Did you know that last year, 2017, more tax foreclosures were filed in Philadelphia than mortgage foreclosures? Now, we were able to resolve a lot of the tax foreclosures, so I can't tell you that more homes were sold at share sales due to unpaid taxes than due to mortgages. I don't think that's true. The numbers on that are hard to gather, but I doubt that that's true. I think in many ways the city files starts a tax foreclosure sale in order to sort of like get the person to pay. But the truth is that tax foreclosures are a huge deal in Philadelphia. When I started doing this work, tax foreclosure. I told you before I work up in North Philly at Broad and Erie. And when people come to see us, obviously we say, "Hey, what brings you here today?" Tax foreclosures or property taxes, and specifically property taxes, were the 9th most common issue that people came to our office in North Philly with. For the last 2 years, property taxes are the number one issue that people come to see us about. More than healthcare and Medicaid issues, more than food stamps, more than anything else to our North Philly office. So it's years ago, Mayor Nutter. Oh, I almost forgot his name. Mayor Nutter famously said that there was a culture of non-compliance, with taxes. And I can tell you now, that culture of non-compliance is done because the city they won't let you go too long without paying your taxes before they start going after you. All right, so tax foreclosures, by the way, they typically affect seniors more than they affect younger folks. And you know why?
No.
It's because of the first top thing here. Younger folks typically are paying on their mortgage still. And when you're paying on their mortgage, the mortgage company, these days definitely, but the mortgage company requires you to pay a little extra every month, which they set aside in your escrow, and that pays taxes and insurance. But for people who have paid off their mortgage, they're responsible for paying their taxes. And if you run into some problems and you don't pay it for a year or two, then the city will start going after you. So the first thing that when people come to us because they're behind in their taxes, and we're not talking about huge amounts. We're talking, for let me do some math in my head. For if your house is $100,000, your property taxes I think are like $1,400 a year. I think, yeah, $1,400 a year. So if you're paying them monthly, then your taxes are $120 a month.
That's a $100,000 house.
$100,000 house, yeah. The tax rate's like one, and so that's like rough rule of thumb, back of the envelope math. And there's a bunch of programs that are available to homeowners, especially what we call owner occupants, that can reduce your tax bill even more. So when people come to us, they're facing a tax foreclosure sale for $2,000 because they haven't paid their taxes for 2 years. The first thing that we look at is, are you enrolled in the Homestead Exemption program? Have you ever heard that before? The Homestead Exemption? Yeah. All right. So this is super important. It's a one-page form that reduces your taxes by like $400. Well, nowadays it's like by $415. And Mayor Kenny has proposed increasing the Homestead Exemption, which would save you even more. It only applies for owner occupants. So, ma'am, a moment ago, I didn't catch your. Ma'am, what's your name?
Mark.
No, Pamela. Okay, so Pamela was. Sorry, I should have asked that earlier. A moment ago, Pamela was talking about sort of like non-residential properties. Maybe like you own 2 houses or something like that. Homestead Exemption only applies for the one that you're living in, the owner occupants. But you certify that you're an owner occupant of the property. They'll check it with your deed and your water bill and a few other things, and then they'll knock off $30,000 of assessed value. So if your house was $100,000, they're now assessing your property for $70,000, and they're basing the property tax on that.
Why is it the same for all property value? That doesn't seem fair.
This is why I think it's fair, because it's a progressive tax. It means it's more of a benefit for people who own lower valued houses. Now, so it's not a flat tax, as it were. It's a tax which favors people who have lower valued homes.
Don't the people do their properties done up by 3.5 since they owned it?
Right. Right. I hear you. But that's fine. So I'll, just to play off of that a little bit more, and this is going a little bit in the weeds of municipal tax policy, but one of the things that Kenny has proposed is increasing the tax rate, but also increasing the homestead exemption to $40,000. So if that happens, it's actually, and assuming that your assessed value stays the same, which I know it's not, but but on the same valued properties, if you increase the homestead exemption by $10,000 and you increase the taxes by like 9%, people who own homes under $200,000 actually get a tax break, which I think I'm okay with. Now there's other issues, whether the assessed values are corrected and all that stuff, but on that particular issue, I think I'm okay with.
Yes.
I just want to say, under the mortgage foreclosures, they had a lot of things to come forward, and there's a lot of agencies to help people with mortgage foreclosures. But with the tax foreclosures, a lot of stuff wasn't in place. And the one thing that they did put in place is this agreement where you can pay, I guess, I don't know what it was based on. The lowest you could pay was $25 a month towards your taxes. But if you're 62, you might have it because you're retired. But if you're one of those people with a tax foreclosure and you're between 50 and 62, you have a problem because then you lose your job, you can't pay $25 a month. So it's like nothing else in place there, and the city doesn't do anything else for you. So I'm like, I would like to get those people and do a class action suit against the city, because you'd rather take those people out of their homes and dump them into the homeless population, and that infrastructure is just not there to catch them.
I feel like you're like a plant or something. Like I put you there because there is now, and there's going to be actually a press conference on Monday. It's Monday it's going to be on this Monday, the 7th, on this exact thing. Remember a second ago I was talking about the owner-occupied payment agreement tier 5s? That's for those folks. Because, but before I get there, let me do the build up, because I need to explain what an owner-occupied payment agreement is, and that's like number 3. So 5 years ago, if you were behind in your taxes and you wanted a payment agreement, I don't think it's too much of a secret to say that it all depended on who you knew. And maybe you were a committee person and you could get a $25 a month payment plan. Wow. Maybe you didn't know anybody and now yours was a $200 payment plan. There were no standards at all. It all depended on your sister knowing a guy who works down at Revenue.
No, just going to CLS on Broad Street. And as a matter of fact, I think the guy that was there said he helped negotiate that deal of $25 a month. And then all of a sudden he got hit by a car or something, I don't know. It's like, and I was like, this is really weird. Yeah, this is exorcist thing. I'm like, oh, okay.
Are you talking about Monty? Do you know? His crushes?
I don't know.
He always wears black? Yeah. So I'm laying the groundwork to get to where I can like really fully answer your question. So it used to be you knew a guy, right? And yes, I didn't want to say it, but since you sort of called me on it, or if CLS called down and said we want a payment plan, a fair payment plan, they would give it to us. They would give our clients it, right? But if you didn't have a lawyer and you didn't have a friend, then there was no standards. So then there was an article in the Philadelphia Inquirer saying that there was $4 billion in outstanding property taxes, and City Council was sort of pressured to do something about it. And so they started cracking down on people who were late in their taxes or behind in their taxes. At the same time, though, the guy at CLS that you might be referring to by the name of Monty Wilson sort of led a group of advocates who got the city to adopt this thing called the Owner-Occupied Payment Agreement, which was the first of its kind in the country, which basically said as long as that said okay that they will give you a income-based repayment agreement for your back taxes. And as long as you stayed current on this income-based repayment plan and you paid your future taxes, you were fine. They weren't going to do anything about your home. They weren't going to send it to sheriff's sale or anything like that. And so these owner-occupied payment agreements became wildly successful. Something like 6,000 or 7,000 people per year get into owner-occupied payment agreements. And if you're super low income, then, as you mentioned, it's $25 a month, which means that some people have owner-occupied payment agreements of like 15 years. And if you were a little bit more income, they might be $50 a month. If you're a little bit more, it might be $75 a month, etc.
Don't you have to be behind on your taxes to get that done?
Right, that's the only reason for it.
So then
Yep.
you, in a sense, never really pay all your taxes.
Well, as if you miss a monthly payment, then they sell your house at sheriff's sale.
No, what I mean is you never actually pay the tax debt.
Well,
If you're paying so little money a month.
true. I mean, that you're paying it off very slowly.
Right. If you're taxed $7,000 a year and you pay $25 a month, you're
I
never
see.
going to pay the $1,000.
I'm sorry. So there's two components. The owner-occupied payment agreement is for your back taxes, and then you have to stay current on your taxes going forward.
If you can't pay your back tax, how are you going to stay current?
Okay, so this is all leading up to what this question was, which is, what about the people who can't even afford to pay $25 a month? And what about people who can't afford to pay their future taxes? And in October or November of last year, City Council passed the Tax Foreclosure Prevention Program. This is the thing which is going to be announced at a press conference on Monday, and it created Tier 5. It used to be for owner-occupied payment agreements. It was Tier 1, 2, 3, and 4. Tier 5 is for people who can't afford to pay $25 a month and can't afford to stay current on their future taxes. And for owner-occupied payment agreement Tier 5, these are the folks who, if you qualify, your taxes will be liened against your property. So recognizing that you can't even make that payment, and so every year a lien for the value of the taxes will be added to your property. I'll tell you, there are some people who really don't like that idea because they feel that part of home ownership should be paying your taxes. We have always said, sure, we got kids in the public, or I have a daughter in elementary school, in the public school. I believe in taxes. I believe in the public library. I believe in taxes. But if somebody can't afford to pay their taxes, then they can't afford to pay their tax. You can't get blood from a stone. And I'd rather sort of like lien their property for those taxes, which you can then get when they die or they sell their house, than kick somebody out of their house, causes blight in the neighborhoods and homelessness.
So if you have taxes, a person died and they had taxes in arrears, and you just recently owned the home, you still have to pay their taxes?
It'll continue to be owed on the home. That's true. So you will at some point need to pay those taxes. But if you qualify for you can qualify for an owner-occupied payment agreement though on your parents' taxes.
That's why they say always check before you buy a house to make sure that everything has been paid on it, so that when you move in, you don't have nothing.
Well, this works out good in Philadelphia, since it's a city where even low-income people own their homes, because when they bought their homes, it used to be $5,000. You own a home. You got a lot of problems now with gentrification, right? But it works out good because this way they can still give it to their kids. Understanding that the kids are going to pick up those back taxes with the lien on it, and that's understandable, because they can make arrangements, for that. And some might decide they want to keep the house, and some decide they don't want to sell it because sometimes they move to another city. You know what I mean? They don't want to come back, and they don't want the house, they don't want the responsibility, and they don't want to be landlords. You know what I mean? So it works out. And this way, this person stays in the house, and you're not throwing them out in the homeless population. Besides the fact they work for the house, they paid them, the mortgage on it. You know what I mean? So it's not like they got something for free. They work for it. They paid for it. You know what I mean? So it's like, I don't know why anybody was sitting here and say something wrong with that.
Well, I agree wholeheartedly with you. I was part of the team that was working to get the Tax Foreclosure Prevention Project passed by City Council. I'll tell you what we kept hearing, though, just to give you the counter argument, which is this. Every time we make that argument, somebody would stand up and say, but my neighbor, and have a story about how their neighbor, or somebody that they know, can, has a new car and is not paying her taxes. And that's, so just to let you know, that's the argument that we're kept running up against.
I don't know, maybe talk to the neighbor and find out why they're not paying taxes.
That's what we say.
Some people spread stories out here that you don't have to pay taxes. And I'm like, as long as you live in,
Yeah.
taxes, okay?
Right.
Yeah, but some people spread that story.
Right.
Right.
Culture of non-compliance. I know.
You don't pay taxes. You keep your stuff in a box or something. You present it, and this person won their case.
Yeah.
I've heard that before, and I'm like, yeah, right, okay.
Right.
As long as you live in here, live and breathe, and you got to drive over the roads, you got to enjoy it with everybody. You got to pay taxes. And somebody's got to pay for that.
Yeah.
You know what I mean?
I hear you.
Maybe you can talk to them.
All right, so let's talk. We don't have too much time to talk too much about sort of other property tax programs. The one that I just want to highlight, though, is that if you no longer have a mortgage and so you are responsible for paying the property taxes every year, you can qualify for a monthly tax installment plan. For some people, it's a lot easier to just pay their taxes monthly than it is to come up with $2,000 every February. What's that? No. So if you qualify, right? So if you qualify for the, and it's not everybody that qualifies, but if you qualify for the monthly installment program, they won't add late fees or penalties.
But I can't pay.
Right. I know.
Yeah, in the summertime, you decide you're gonna pay for the 3 months off early.
I hear ya.
You know, because you're not working for the summer months.
Right.
No, they don't, you have to
Right.
pay, come in monthly on the thing, you're like, doesn't make sense. You know,
Right.
I got the money now, why can't I pay off for the summertime, you know?
Right.
And then you get in trouble right there too.
You know, we just had to deal with. We just fixed this, but for a couple of years, what was happening was that this ties property tax to reverse mortgages. Reverse mortgage companies would check the rolls, the tax rolls, like every summer, and they'd say, "Oh, that person hasn't paid their taxes. Oh, that person hasn't paid their taxes." They couldn't tell that somebody was enrolled in one of those monthly installment plans. So they were, even though somebody was active in their monthly installment plan, if they had a reverse mortgage, the reverse mortgage company was coming in, swooping in, paying the taxes, and then turning around and saying, "All the money right now." Yeah, we fixed that. But when you just said that, it reminded me of that issue.
Reminds me of guys also come to town and do these tax lien things, you know, like,
Tax lien sales.
Kawasaki and all them things.
Yeah.
And you get people looking up records, you know,
Yeah.
for people who haven't paid their taxes, and they cause a lot of problems.
Oh, yeah.
for people. You know, they come by and
Let-
somebody's living in the house,
Yeah.
and it's like, oh, wow, you know, like, let me start a sheriff's
Right.
sale for this person. I'm telling you, these people need to be shot. They really do.
So let me tell you. Oh, there was one other piece that I wanted to address before we talk about property tax foreclosures, which was you had mentioned that housing counseling agencies were providing assistance with mortgage foreclosures, but not with tax foreclosures. That is also now changing. The housing, as folks may know, there's about 24 housing counseling agencies across the city. Many of them very, very good. And they have traditionally, at least for the past 10 years, have been helping people with mortgage foreclosures. They have now received funding and training so that you can go to them with tax foreclosure questions as well. If you get 10 years ago, we fought so that the mortgage company, when they sued somebody in mortgage foreclosure, the top page of the foreclosure was a form that we designed that said, if you want to talk to a housing counselor about your mortgage foreclosure, call the Save Your Home Philly hotline at this phone number. And people called it. It's a phone number that's staffed by our colleagues at Philadelphia Legal Assistance, and people were being connected by housing counselors that way. Last year, we were able to get the city to use a very similar form so that when you get sued in tax foreclosure, you get the same cover letter that says, if you want to talk to somebody about your tax foreclosure, call the Save Your Home Philly hotline and to address the same thing. Sorry, we kind of got a little off track there. I'm gonna try and bring it back. I love talking about this stuff though, so I'm very easily distracted by talking about certain things. I did want to mention property tax foreclosures though. I think I have a little map for you. This map. So this map are seniors only, defined as people 60 and over, who are behind in their taxes by $2,000 or more, as of February 2018. So this is only 3 months old. And every red dot is a senior homeowner who owes $2,000 or more on their property taxes. So we're actually going to start this program in July where we're going to be paying people. When I say we, it's not Community Legal Services, but it's our sister organizations. Are going to be paying community activists to go knock on people's doors saying, we understand from the city that you owe $2,000 or more in your taxes. Here's a list of the programs that you may qualify for in order to save your home. We're going to try and be a little bit proactive in this. I don't know if it's going to work or not, but we figured we might give it a shot. It's a good question. Do you know the folks at Logan Logan, right? Do you know the Logan CDC? Is there something Logan something CDC? Let's talk as soon as this thing is done, because it's the neighborhood organizations that are getting the funding to hire people to go door to door.
We'll have a listing of their addresses.
Yeah, I mean that's the idea. I don't want to overpromise something here because we're sort of targeting neighborhoods where there's a lot of tax foreclosures, and I don't remember seeing Logan on that list, so I don't know. I remember, it's usually Strawberry Mansion, Point Breeze, Grays Ferry, and out in Cobbs Creek, Kensington, King Sessing. All right. So, we're on to Wales. So this is the point. If you or anybody that you know falls behind in their taxes and gets sued in tax foreclosure, we have implemented a procedure so that even if you've been sued in tax foreclosure, it's not too late. You get into an owner-occupied payment agreement, and it stops the process. At the top of this, I said that there are more tax foreclosure sales that were started last year than mortgage foreclosure sales. But I also said, but I don't think that there were actually more people that lost their homes to tax foreclosures at sheriff sales. And the reason is because the city is using this as like the kick in the butt to people. Like, pay your taxes, we're going to sue you in foreclosure. And guess what? It works. Don't tell anybody I said that, though. But it actually does work. If somebody gets sued in tax foreclosure, turns out they come up with the money. All right. I feel like I can't talk about this stuff without talking a little bit about getting a will. All right. So when you have a major life event, and for me it was when my daughter was born 9 years ago, I figured, okay, I should be like an adult now and get a will. And so I went down the hall at Community Legal Services, where there's lawyers all over the place. And I asked them, who did your will, or do you have any references of people that did their will? And literally no lawyer on my floor had a will. Wow. I know. Right. I was like, what? Right. I know. So I tell you that story to try to tell you that if you don't have a will, you're not alone. A lot of people don't have them. But if you have a house or anything else of value, and you don't think that it's going to be clear when you die who gets it, even if you do think it's going to be clear, it really is worth there are some places that will do it for free. Drexel University Law School has a clinic where they'll do a will and power of attorney and something called an advanced medical directive for you.
I don't like the way it reads. I have all three of them. I looked at that and said, oh, hell no.
You have one? Is that what you're saying?
I have
Yeah.
those documents. He said, you can write the way
Yeah.
I want it. And I'm like, now I need help writing the way I want it.
Yeah.
I don't like what it says.
Yeah. And I'm not a specialist in wills or things like this. But I know that first of all that it's rare. That's when somebody comes to our office who's usually it's their mom or dad who has passed, and they're trying to figure out who gets the house. But boy, it's so much easier. So if you have a loved one, whether it's family or chosen family or children or nephews or friends or whomever that you want to leave your property to, you would do them a great service to spend the time and money now than have them all battle it out after you die.
Do they have to know it?
No, but they should know it. It's a good question. The question was, do they have to know it? No, but they should know it because it's a difficult conversation to have, right? About like, oh, sorry, son, I'm writing you out, or sorry, nephew, I'm writing you out, or, I don't know, maybe you're estranged from your family, you haven't talked with your family in years or whatever, but they still think they're going to get your house. It'll cause the person, it'll be nicer to the person that you are actually leaving the property to let them know now, so that there's no surprises after you die. Plus, they need to actually locate the will too. By the way, you know this.
Especially my family members, when mom and dad don't tell it, because who's going to have what, and then they argue and fight over material things that they die. Yes. One person seems to get everything because they've been doing it before mom and dad died, or they know what to do as soon as mom and dad died, and they get everything, and one person, all the rest of the family's left out. I've heard of stories.
I've seen them all.
Alright,
That's what happened to
you
me.
can't put your name on, go around, just put your name on, oh, my daughter's gonna have this sofa, and no, it's gotta be in the will, and specifically, all your material possession,
Yeah.
and the name of who's going to get what, because they
Yep.
will argue about it, you'd be surprised.
Well, that's what happened
Yep.
to me when my mom died.
Is that right?
Ain't none of us get nothing but my older sister. But I didn't really want nothing because it didn't matter to me.
Well, here's just one thing to know as well. Like when you do a will, how will, after you die, how will the people know that you had a will?
Well, first of all, my son knows.
Okay.
My son knows where the wills are.
Okay, and that's the answer. You have to actually tell somebody where the will is. You have to, or give the will to somebody. Some people think, oh, do I have to record it in the city hall or something? No, you don't. You have to actually tell people where they are. I'll go with you.
You could have a will and it's not, like they don't know about it in the city?
But that's a bad idea because then you die, and
They don't know where
everybody's
Right.
like, "Hey, it's Tyrone, right?"
Right.
Yeah, I caught your name when you came in. It's like, "Hey, did Tyrone have a will?" And everyone's like, "No," So like, all right. But if you tell people about it, then they'll know when you die. Yes, sir.
I have a video will, and the credit union that I belong to has it. So when if something happens, the credit union will, and they have the people do that. I recommend a video will because
There's a video.
less chance of attention.
Okay, I don't know whether that's legally effective in Philadelphia or in Pennsylvania. It's not. My specialty is sort of in like property and tax and consumer cases. It's not too much of a will. But so I don't know.
The credit union or the bank, I
Yeah.
thought was
No.
required.
No, they're not required to do anything. It has to be somebody who knows. Oh, his will is over there. He goes.
And you cannot put anything in the will that has your name, beneficiary, like from your job, from insurance, and from your pension. Whoever's listed on those documents is a beneficiary, they're gonna get it.
That's correct.
Your will can't.
Right.
what do
Say
you-
something different.
Yeah,
Exactly
they
right.
say something different from that.
Yep.
So you gotta change it on those documents.
That's right. And if you do a will and then you change your mind, you can do another will. It's the last one time that matters. You just have to make sure that you tell everybody you're changing your will. Yes, ma'am.
Okay, this doesn't pertain to will, but I keep getting this letter from my bank, and they keep saying, I have free insurance on their behalf. And
Oh, yeah, for
it makes me
$1,000.
feel kind of leery, because I'm like, what are you trying to kill me? Why would you want to offer me free life insurance?
I think they're just trying to be nice.
Yeah, it's just being a member, it's only
I'm not going to say don't
$1,000.
sign them out. Okay, that made me
They
think
said it's a while.
Yeah.
It's only $1,000. I mean, at least you have something to cover you to die if you die. You get another union, you get another $1,000, that's
Yeah.
$2,000. About $2,500, you can get a decent burial. You know what I mean?
All right. So I could talk for plenty more, but David, I feel like I should check in with you. How are we on time? Can I keep going, or when do you want me to stop?
Yeah, I think if you want to take another 10 minutes or so,
Okay.
then we can end with some more questions.
Sounds good. Okay. Yes.
Now, with a living will, you got to be careful with that too, because if something happens to you and you're not capable of making decisions or anything, you gotta power of attorney. You gotta make sure that you have the right person that's going to take care of you, because if you don't, and you have someone on that paper can take you for everything you got. And where
That is
there's
true.
no problem because their name is on the power of attorney.
You know how I spent like almost 20 minutes, 30 minutes talking about reverse mortgages and making sure that people are sort of like aware of all the situations. I could do the same thing and more for powers of attorney. And I could probably do the same thing and more for guardianships and other things as well. Powers of attorneys are incredibly important. I have given somebody a power of attorney for me because, if my bus going home tonight, gets into a crash and I go into a coma, I want somebody to be able to access my stuff. And I want to make sure that the person that I've given it to is somebody that I trust.
Oh, I made a mistake. Don't let them sign it yet. Like you have no. Listen to what I'm saying, because my insurance man told me. He said that if you have insurance and you have a living will, do not let that person sign that paper yet until you feel as though you're not going to be able to do it.
Okay, so we've been talking about powers of attorney. There's this other thing, which some people call living wills. Legally, they're called advanced medical directives or advanced medical directives. Essentially, it's like this is when to pull the plug. Is that what you're talking about? Right. Yeah. Yeah. There are some people who have prepared it, but they themselves haven't executed it yet. In the event that they want to change their mind at the last minute.
Well, that's what I'm
So
saying.
yeah.
I did that. I mean, I haven't changed my mind on
Right.
who's supposed to,
Yeah.
But
Well, maybe if the initiative wants to sort of like talk about like end of life issues, it's a whole nother.
We have some stuff coming up.
Oh, sweet. Talk to David. David will schedule this. Make sure you come to that session because that session is going to talk about all this. Alrighty. All right. One other thing I want to talk about, and that is the deed to your house. It's important that you know how, if you own a house, it's important to know how you own the house. Because you may decide, oh, I want that to go to, my nephew. But in reality, your deed is written in such a way that won't allow you to leave it to your nephew. And let me tell you what I'm talking about. In Pennsylvania, there are essentially 3 different ways to hold property, 2 or more people to hold property. Tenants in common, joint tenants, and tenants by the entireties. And just to make it easier to understand, joint tenants and tenants by the entireties are the same, except for tenants by the entireties are between 2 spouses, and joint tenants are between people who are not the same spouses. Tenants in common mean, all right, if me and Gail were to buy a house together, we would own it. I would insist that we own it as tenants in common, which means that when I die, my half of the house can go to my heirs. And when you die, your half of the house go to your heirs.
I don't want that.
All right. Listen though. I'd probably sell it to get the money. Point is, instead of, and you wouldn't want to be living with my heirs either. But point is that if you're holding the house as joint tenants or tenants by the entireties, when one person dies, the other person owns the whole thing. Get it? All right. So this is a deed that I had pulled for some other reason. This is the house that Malcolm Jenkins. Does anyone know who Malcolm Jenkins is? Yeah.
Oh, wait a minute. I know.
He's a football player. Yeah, he's a Philadelphia Eagle who does it's almost like being a Philadelphia Eagle is the second most interesting thing about him. Most interesting thing about him is he is an incredible advocate for criminal justice reform. But Malcolm Jenkins and his wife, Marissa Jenkins, husband and wife, tenants by the entireties. Remember, and this is when they sold their house to Vanessa Ann Cope and Jeffrey S. Cope. This is in 2016. This is an example of 2 people owning a house as tenants by the entireties, where now this deed says that they sold it, but if they had still owned it, if Malcolm or Marissa were to pass, then the other person would own the whole thing. So I say this because, I don't know your personal situation or anything, but let's say you bought a house with somebody years ago, don't like them anymore, you bought the person out, but you never changed the deed.
Oops.
Now, and you're owning it by joint tenants. Now, if you get rid of divorce, if you get divorced, tenants by the entireties automatically converts to tenants in common. So there's that. But if you purchase a house together as joint tenants because you weren't married to the person, and things went south, and you said, "Look, I'll just give you $10,000 to get out of my life," but you never changed the deed, when you die, you may be in for a rude awakening when the person that you bought the house with as joint tenants now owns the whole house.
Except what if we had an agreement, a contract that says that you bought them out?
Need to change the deed.
Okay, speaking of property,
Yeah.
is there such a contract as heir property? Like, say if you have so many children?
Okay, so an heir property is when we use that phrase, which is kind of like it's not like an official word, but what we mean by that is that you have inherited the house from somebody, and their name is still on it, and so it's not really in your name yet or ever. So if you are inherited the property from your mom, for example, then unless you what we call probate your mom's estate and do a deed transferring the house from the estate of your mom to you, your mom is still what we call the record owner. So that's an heir property. Some people, do I want to leave? I don't want to leave it on this. Oh, what the heck? I'll just leave it. No. All right, I'll say this thing. Philadelphia, just as we love our homes and love our neighborhoods, we love like doing really weird things in our deeds. I go to like different conferences across the country, and and I explain these deeds to people, and they're like, "No, we never do it like that. We don't like this is just a Philadelphia thing." But it is not uncommon for a Philadelphia deed, especially from the 70s or so, to be like, from the seller to, I'll just use my own example, Michael Froelich as trustee for his daughter Zora Gilbertson Froelich for as long as Zora Gilbertson Froelich can live, and then to Zora Gilbertson's children who are boys but not girls, or something like that. Like these like weirdo things in like trying to like put the will in the deed. They're so common that we have a phrase for them, which we call them South Philly trusts, because for some reason they seem to always happen in South Philly, and there's nothing which prevents you from doing a lot of this stuff, and I've talked with every time somebody comes in with a deed like this, I'm like, all right, tell me, like, what was she thinking? Like, why did she do this? Like, what was going on? And usually what they say is, we wanted to do this to avoid inheritance tax, because you can get around like inheritance tax, right, for this reason. And so I'm like, all right, you may have saved a couple $100 in inheritance tax, but what did you buy with that $100? You bought this crazy mess of a situation that oftentimes you've got to go to orphans court to see if it's even valid, and you've got to sort of track down heirs and stuff, and you've got don't get fancy with your deeds. That's fine. So when you buy your house, don't just make it like a regular deed. Otherwise, you're gonna like keep some lawyers busy when you pass. All right. So I think I'm gonna wrap that up. There's more I could say, but I think that's the most important stuff. Anyone have questions? You want to talk about stuff? Yeah. Sure.
On the reverse mortgage issue,
yeah.
Again, besides the issue of the taxes and the insurance, is it a good idea? What is the advantage, again, just summarize?
Sure.
If you're house rich and...
If you're house rich and cash poor, and you don't have anyone that you're really want to leave it to, then and you're when I say cash poor, what I mean by that is you want to be traveling, and you don't you just want to live. You just want to live, or you just want to live. Yeah.
Some resources.
Yeah. Exactly.
It's not enough to carry on a reason.
Then I can see doing it. Why you I think it's maybe easier for me to tell you why you shouldn't do it. Why you shouldn't do it. Why you shouldn't do it. Don't do it if you have people that are expecting to inherit your house, or don't do it without telling those people there's no house for you. Don't do it if you have enough money, in retirement, and you're not hurting. But yeah, the reason you should do this obviously is to cash out and to get money. And don't do it without knowing that you will have to continue to pay property taxes and insurance.
property tax and the insurance, what is the HUD insurance we're talking about?
The HUD, yeah, I want to be clear on that because I think I might have conflated that. When we talk about the HUD insurance, there's 2 times in which it's charged to you. Neither of those times do you actually pay it out of pocket. The first time is at the closing table. At the closing table, it's just added, or I guess it's deducted from the amount of money that you would have otherwise received.
Okay.
So you otherwise would have received $50,000, but now you get $47,000.
Okay.
Right. The other place that it's added is every month your outstanding balance will go up a little bit because the insurance will be added to it. Again, that doesn't come out of pocket, but it will. And the only reason why you would really care about it is if there are some heirs who are thinking that maybe they might want to buy the house when you die. It may become part of the math that they'll need to do in order to qualify.
But the small amount that you're saying that's added every month goes on to your total bill or what you...
Yeah, we would call it the outstanding principal balance.
Okay.
That's the phrase we would use.
Well, what happens, let's say, if you take out a reverse mortgage, let's say you're 50 years old, 60 years.
No, you have to be 62.
Let's say you're 65, you take out a reverse mortgage. Then you're 75 and you have to go to assisted living or something. Then what happens?
As soon as you're out of the house for 12 months or more, they will initiate a foreclosure process due to occupancy.
What happens to the money? Let's say you were taking a monthly sum.
That I don't know, actually.
Or, the lump sum. If you have the lump sum, I guess that's it. You already have all the money. But if you were taking a monthly sum. And that's the next question. Do you get more money by taking a lump sum or by taking a monthly sum?
The lump sum is more money. Or, I mean, the monthly is more money over the long run. But
if you live and you're in your house long enough.
Yeah.
So you don't know. It's actually a gamble.
Yeah.
Because you could take a monthly sum and God forbid you get run over by a car.
Right.
In 3 months. That's it.
So let me. I need to be really lawyerly about this and give you a little caveat here. For your particular situations, to get really in detail, I can talk with you about the law about it. But there are people that are much more qualified than I am to talk to you about sort of weighing the different options. Because maybe what you really would want is a home equity line of credit, maybe not a reverse mortgage, maybe you'd want to purchase an annuity, maybe you wouldn't. But so I would really recommend, like, once you get to the level of detail where you're like, this does make sense to me. Maybe I want to like figure out I would recommend talking with some kind of financial counselor. Yeah. Yes, sir.
Are there things to keep military veterans from being losing their homes in a certain place? I thought another claim that kind of done other things that keep veterans from being homeless.
The two that I know of, or to homeless. Okay, yeah. The three pieces that I know about that. Number one is that if you're on active duty, then they freeze your tax. I mean, they'll freeze your taxes, but they won't. They'll sort of just like postpone the payment of the taxes until you get back. That's right. If you're actually, the two I'm thinking about is active duty. The other active duty is that if you're on active duty and you're facing foreclosure, then they aren't permitted to file the foreclosure against you until you get back. But the thing I think you might be referring to about the vets is that the city of Philadelphia got a bunch of money recently to specifically provide housing for vets, with the goal of reducing homelessness among veterans to zero. And I haven't been directly involved in any of that, but from what I hear, secondhand, is that they've been pretty successful. Yeah.
Staying in your house with a reverse mortgage as long as you live, is that even if you take a certain amount monthly, let's say, and you get to the point where it's worth the house, and you still stay in the house, you just wouldn't get money, right?
Exactly. Yep. Yeah. And that's right. And I should tell you, so what the 100% of the people that I talk to take out all the money right away. Yeah. So I'm less familiar with sort of the options with people like pulling that. Any other questions? Yes, sir.
What is the legal question around a person that's been incarcerated and they own a house, and he might be the husband or the boyfriend, or she might have got incarcerated. I mean, who pays what in that aspect? I don't understand.
Right. Yeah. So there's lots of pieces to that.
Okay.
So can you are you thinking of something in particular, or just do you want me to stop?
Well, I know a lot of cases. I've heard a lot of
Yeah.
different stories about that because I know in the city of Philadelphia, I'm sure there's a lot of problems around.
Right, there are. I mean, one way to deal with a lot of it is for when people go away to do a power of attorney to the person that's here. So the person that's here can transact a lot of the financial business. Oftentimes what happens is that the person that goes away had an income that the person that was paying the mortgage, and so they go away, and now you can't afford the mortgage anymore, and so you're going to foreclosure. And the thing about being in foreclosure is that we can get a loan modification to sort of lower the payments a little bit, but only within a certain parameters. And so if like 80% of your income stopped, it's going to be hard to keep the house. So those are some of the issues that we deal with. People that get locked up. Yeah. Other stuff. So we could wrap it up, or we could cool. All right. Well, thanks everybody. This is fun talking about this. I love talking about this stuff.